Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we review the 2020 property market. Louis, thanks for joining us.
Nice to be with you, Peter.
Louis, how did the Sydney housing and apartment markets fare in 2020 overall?
Well, it was a crazy year, as we all know.
Yes.
But at the end of it, the market is actually up overall in Sydney, just.
Yes.
Looks like that it's going to come in as being about 3% up. So houses have done a lot better than units in this cycle. And the reason why is because people, as a result of coronavirus, have been looking for larger properties and they've been looking to get away from the inner city locations. Hence the reason why units for the year are actually down. It looks like they're going to be down by some 6 to 7% from what we can see.
What did the closure of the international borders play in that? What role did it play in that for apartments, Louis?
It played a significant role. To begin with, you may recall we had a situation back in March and April where a whole bunch of Airbnb property owners suddenly couldn't find a short stay, and they then started to lease their properties into the longer term leasing market. It was hemorrhaging because we weren't getting migrants coming into the country. We weren't getting international students coming into the country. And so many of these Airbnb property owners tried their hand in the long-term leasing market and realised that there was no luck there. CBD rental vacancy rates really shot up. And when I say shot up, they got up into Sydney up to about 16%.
So that's a crash in anyone's language.
Rents fell by about 30%.
Yes.
That's market rents.
What role did developer oversupply of stock play in all of this?
There was a part role to it. We were, for this year, scheduled to complete 170,000 dwellings nationwide. And we think 170,000 dwellings have actually been completed. We don't think too many have actually been suspended. So there was an increased supply despite the fact that the international border was closed. So there was no possibility of absorbing that new supply with new demand. And so there was a contribution. But I would like to say, of course, that even while we had this spike in rental vacancy rates for the CBD areas, we saw the reverse for the outer urban areas and regional Australia. So for example, Sydney's Blue Mountains, the rental vacancy rate fell from about 4% pre-coronavirus down to under 1% now. And rents have really taken off in the Blue Mountains. And we've seen a similar thing for the Central Coast as well. So satellite outer urban areas across Sydney, Melbourne, Brisbane, Adelaide as well, have done actually really well with coronavirus because everybody's been looking to move out of the inner city areas.
So in summary, the coronavirus caused mass disruption on the property market and there was winners and losers out of that.
That is correct. That's exactly what happened. And the biggest winners of all have been regional landlords, many of them of which have seen huge rises in market rents.
So coming into 2020, can we recap what your forecasts were? And obviously these forecasts were pre-coronavirus, of course.
So pre-coronavirus, we believe that the recovery that was occurring in the second half of 2019 would accelerate based on lower interest rates, basically loosening of credit standards, and some relief, of course, on the fact that negative gearing changes were not going to actually happen due to the surprise Liberal National Party victory of last year. Of course, coronavirus hit, and we did have a scenario that took into account a situation where interest rates would have to be cut to zero and quantitative easing start and the economy go into recession. We thought potentially the catalyst for that was a breakdown in trade relations between China and Australia. And of course that has now kind of happened. But what we didn't, of course, forecast was coronavirus itself.
Indeed.
But the response to coronavirus was very similar to the response we were expecting for that type of breakdown in relationship between China and Australia. And sure enough, it has assisted the market. It's put a floor underneath the housing market through lower interest rates, heaps of government stimulus, as we all know. And those two have managed to kind of keep people in jobs and also made the serviceability of paying a mortgage that much easier, and for new people to enter into the market that much easier given how low rates are now.
I think it's fair to say for the drama and the issues that faced the market in 2020, it held well, prices did. What about transaction numbers? Were people trading en masse, or did we see a tightening in that space?
Well, effectively we saw a suspension in the market for a number of cities really from the end of March through to June, July. There was not much trading at all that occurred. For a number of cities, of course, were in lockdown. In Melbourne, for example, you were not actually even allowed to see a property as a potential buyer. So it's very hard for transactions to occur on that front. As we're all aware too, we had the auction suspension effectively. You couldn't conduct auctions for a while. So all that effectively meant that the trading of properties more or less became suspended. But as we draw to the end of this year, 2020, we have seen a real pickup in sales transactions and a pickup in auction clearance rates. So I think for the fourth quarter of 2020, the numbers will show a massive turnaround in sales.
Based on that drop in transaction numbers for the year overall, do you see that there's a case for pent-up buyer demand in the market?
Potentially. I think there's been a lot of people who are looking to change their affairs, as you normally see each and every year.
Louis, I do want to cut across to auction clearance rates now.
Yes.
Earlier this year, we had a discussion with you where you weren't happy with the quality of data being pushed into the real estate market.
Yes.
And you came up with your own report on auction clearance rates in the name of getting more accurate understanding of what's actually happening on auction day.
Yes.
We can see here
Yes.
for the year your auction clearance rate report. What differences are you seeing in the data that you've collected on auction clearance rates versus the numbers that are pushed out into the media on a Saturday night by more traditional players in this space?
Well, regularly we're seeing a situation where our clearance rate, our final clearance rate, is about 15 to 20 percentage points lower than the other bodies that are out there, being Domain and CoreLogic.
So you're saying on a Saturday night or a Sunday morning newspaper, the auction clearance rate number that the consumer is reading is somehow inflated by 20%?
Correct.
And how is that being inflated, Louis?
Through the lack of proper reporting of all the auctions that took place, Peter.
Yes.
So regularly you will see, when you actually look at the numbers reported by Domain on a Saturday, that they're missing regularly 15 to 30% of the results which actually occurred.
And if a consumer wants to get hold of this report weekly, what's the best way to do so?
All they have to do is come to our website. We actually put out our final clearance rates each Tuesday afternoon.
Yes.
And we give the full breakdown in terms of exactly how we've come up with that clearance rate, including all the individual properties, and literally the audience can click on the individual properties and have a look at the ad and how it's now being presented. So full reconciliation occurs, Peter. I couldn't make our series more transparent than what it is.
The other thing your chart demonstrates quite clearly here, Louis, is the crash in transactions around the period of the lockdown in April.
That's right.
And coming out of lockdown, notwithstanding everything we've just discussed, in fairness, the auction clearance rate has gradually eased up throughout the year, hasn't it?
Well, yeah, it's quite the trend when you see it in terms of not just the clearance rate, but the volumes. Now, keep in mind, of course, that crash we had back in March and April, I think that was an all-time low in Sydney's auction clearance rate.
The final thing I'd like to point out from this chart here is how strong 2020 opened. We couldn't believe some of the prices we achieved before the coronavirus took hold.
Yes.
We were getting properties, we were selling properties for a clean 10% over what we told our clients it would sell for.
Yes, that's right. The market had a lot of momentum at the start of 2020 from 2019.
Yeah.
And that was for a multitude of factors as discussed earlier. But of course, as fears rose due to coronavirus, that quickly changed. Yeah. And effectively, I think the market started to be affected by the fears surrounding coronavirus from the first week of March.
At one stage in 2020, Louis, you put forward that there was a case where property prices could drop 30%.
That's right.
You subsequently unwound that or updated that and said that you now viewed that risk had passed. What caused you to make that suggestion, and what caused you also to suggest or be of the view that the risk had passed?
So we actually came out with two scenarios. A scenario where the market would recover after the first wave of the virus and the government would provide stimulus support and that the market would recover. The media, of course, grabbed onto our second scenario, and that second scenario was that there would be a second round of the virus, a second wave, and this was before the second wave hit, and importantly that the government would run out of ammunition to support the economy. Or the government would be reluctant to go into the amount of debt that they did to support the economy. We were cautious that a Liberal National Party would do whatever it takes, including taking out all the debt that they did, to support the economy. And as we now know, that's exactly what they did. Yeah. They were willing to do whatever it took to do it.
Yes.
And hence the reason why that darker scenario didn't play out. But if they did hold back, if they didn't do as much as what they did, we would have seen a crash in this country. I have no doubt about it.
Well, the four main retail banks said the same thing, and then they also all unwound their dire forecasts at a later stage.
That's right.
In the year. So the government was getting a very clear message from the market, wasn't it? If you sit passive here, this thing will crash.
That's right. And I still believe to this day they didn't respond. That's exactly what would have happened. And I think if you ask any reasonably good economist, they would agree. If the government just stood by and let it happen, then we would have had hell on our hands. Not just with the housing market, but we would have had unemployment at 13, 14, 15%.
Riots on the street, social unrest.
It would have been really bad news.
Yes.
And we've seen a little bit of that over in the States, of course,
yes,
because they've been rather dysfunctional in handling coronavirus. So it was on the table, but the government did do the right thing, and full credit to them, and so did a number of state governments in terms of providing that stimulus. And so that scenario was averted.
The RBA cut rates by 0.5% in March, rare for them to intervene to such a degree, and then cut again in November by 0.15%. What role, aside from the government stimulus that you've just outlined, what role did those interest rate cuts play this year in supporting the market and eventually seeing the market finish positive, as you've already outlined?
It played a significant contributing role, Peter. There's no doubt that the housing market, as well as businesses, respond to changes in interest rates because we do have a lot of debt in the system. So when you do see rate cuts, our modelling's been clear on this for many years now, you generally see a positive response in the marketplace. And so that was definitely a contributing factor. But I think the number one policy that helped save the market was JobKeeper and, of course, the expansion of JobSeeker. I think the banks also played a part in managing the situation by not pulling the rug underneath so many borrowers. They could have done it. They could have called in the loans. They didn't. They went into loan deferral territory.
It would have been catastrophic for their own book, though, wouldn't it?
And that's the reason why they didn't do it. And that's the reason why I do believe they're going to be very careful in terms of how they manage the situation. We still have a lot of loan deferrals. And from what I can see in their language, they're gently encouraging people to get back onto the wagon in terms of paying their mortgages. And they've actually had a lot of success in doing that. There is still a risk, though, of course, that we'll end up with many forced sales in 2021. It really still depends on the banks, and it does depend on what ultimately happens with JobKeeper.
Louis, New South Wales Treasurer Dominic Perrottet has proposed an annual property tax in place of stamp duty. At a first glance, what are your thoughts there?
I think it's going to stimulate the market further in New South Wales.
In terms of price or transactions?
Both. It's going to provide a lot of liquidity. I'm a fundamental believer in the tax change for the long term. I think it does actually help affordability
Is it a
in the long term.
fairer tax for the consumer?
I think so.
Yes.
As an owner-occupier, when you basically transact on a property, you'll pay on average about 4% of the purchase price in stamp duty up front. Now, the offer on the table now is that instead of that, you can opt in to pay just 0.38% each year on the underlying land value. And that's a huge difference between paying 4% of the purchase price versus 0.3 of 8% on the underlying land value. And I roughly work out the break-even point in terms of time between the two is about 25 years.
Wow.
So if you go down the option of, as an owner-occupier, paying the land tax, you're going to be ahead for about 25 years. And the reality is most people hold their property on average for about 9 years. So as an owner-occupier, I think this is money for jam.
Louis, something that I've been trying to get across is if you're an investor, a property investor, a would-be landlord, stamp duty is not a tax deduction, whereas land tax is a tax deduction. Do we know where this annual property tax sits on that scale?
I think we need more information and more clarity on the state government regarding this issue. I don't think they've been fully clear on it, and maybe it's part of policy that they still need to release. They're still going through. And let's remember there's a consultation period as well.
Yes.
But it is an important question. As it currently stands on the information released, a property investor will actually pay 1% land tax on the unimproved land value, assuming the new policy gets up. And that, of course, is a lot more than what an owner-occupier will be paying.
Louis, great information today. Thanks for joining us.
Nice to be with you.
And thank you for joining us today on Talking Property. In our next edition of Talking Property, Louis is going to break down the 2021 property market. Thank you.